All right. Hopefully you guys are doing well. Thanks for joining me for Saturday Night Crypto. Is my microphone working okay? It seems like it. Feel free to say hi in the chat. Introduce yourself. This is a community. This is interactive. This isn't just me jibber jabbering. I'm here for you guys. I want to explain how things work in the Ichimoku Cloud strategy and the indicator. It's actually my favorite strategy, my favorite indicator. I've learned a lot of indicators over the years, and this one by far is my favorite. It's like an all-in-one kind of package. It's so good. It's like a whole bunch of indicators rolled into one, and hopefully after tonight you guys will see why I like it so much. But like I said, this is interactive, so feel free to type in the chat, ask questions if you want, say hi. So let's talk a little bit about the Ichimoku Cloud. I do have a real face. I'm a real person, sir. Anyhow, so what is Ichimoku Cloud? It sounds so mysterious, and it sounds like kind of Asian, right? Well, it is an indicator that pretty much, like, if I had to sum it up, it would be an indicator that works off moving averages. But it's so much more than that. So don't be just like, really? You mean like EMA 50? You mean like EMA 20? EMA 200? That's it? A line? No. It's way better than that. But just to kind of sum up what's going on, it uses at its heart a bunch of kind of moving averages on candlestick charts, right? And it was developed by a Japanese journalist in the 1930s, trading stocks and currencies, and he actually spent about 30 years refining and perfecting the strategy before he actually shared it with anybody in the 60s. So he just had all of this time to work it out. And it consists of a few key parts. So let's go over what those are. I'm going to give you the names that people who talk about these indicators are going to use these terms. And so when you see some of these terms, you'll be like, oh, I recognize that one. So I'm going to give you the names for them, but I'm also going to break down what they are so you understand, not just, hey, there are these lines and it's called the Kijin, but like what is that actually? I'm going to help you guys understand it. And if you don't care, it's fine. I'm just going to give you the background a little bit. So one of the main two lines is called the Tankenson, or the Tanken. And it is basically the midpoint of the last 9 price bars, right? So if you're on the 1-day chart, 9 bars is 9 days. It's the midpoint of those last 9 bars, okay? And another line that's very important is called the Kijin-sen, and you've probably heard the term Kijin a lot. Kijin bounce, Kijin this, oh, sell at the Kijin, right? You've heard that one a lot. And the Kijin is basically just the midpoint of the last 26 price bars, right? Let's see what that looks like with an example, shall we? So here is a Bitcoin price chart. It's actually live. And if I turn on the Ichimoku Cloud indicator, I have it only showing here the Tanken. So I colored the line Tankenson, right? Midpoint of the last 9. This bar here, it looks kind of like an EMA or an SMA, right? A little bit, right? But what it actually is doing is it is the midpoint of the last 9 bars. 1, 2, 3, 4, 5, 6, 7, 8, 9. These 9 bars. This point right there is the midpoint of the last 9 bars at this point. Here, it's the midpoint of the last 9 bars at this point. So you get it. You guys get it. All right, it's a midpoint. It's a mean. Totally get it, right? And then if I want to show you the Kijin-sen, which is the midpoint of the last 26, what you would see is this guy right here. Okay? So this red, to correspond to the red here, is the Kijin-sen. The Kijin line, right? And it's basically a slower moving average than the blue one, right? Because it's over 26 bars rather than 9 bars. So the blue one is going to move a lot closer to price, and the red one is going to lag a little bit more behind. It's going to be a slower kind of average of the two, right? So those are the two most important lines that make up the Ichimoku Cloud, the Tanken and the Kijin, and they cross, and they cross, and they cross, right? And the blue one's on top when the price is going up, and when the price is going down, the blue one's on the bottom, right? Like, it's pretty easy to understand how those two work, right? So what else? Like, where does the cloud part come in? So, and also, what the hell is the significance of 9 and 26, right? What does that mean? Well, hold that question, because I will explain that, but it's not important right now. So, in addition to the Tanken and the Kijin, we have the Chiku Span, like, I just call it the cloud top, right? And that is the midpoint of the Tanken and the Kijin. The two lines that we just saw here. The midpoint of these two is going to be the cloud top, okay? Projected 26 bars into the future. There's that number 26 again. Don't worry about it. But it's the midpoint of these lines, 26 bars in the future. And then there's the Chiku Span B, which I just call the cloud bottom. It's the bottom of the cloud. And that is the midpoint of the last 52 bars, projected 26 bars into the future. Chart! Let's take a look at what that looks like, okay? So here we have the Tanken and the Kijin. You know what this is, right? And now I'm going to add the other pieces here. I'm going to add the Chiku Span A, which is this line here. And we're going to add the We're going to add the Chiku Span B, which is right here. And between these two lines, you have this colored area, which is known as the Ichimoku Cloud. These two lines that I just drew, or not drew, but lit up here, form the Ichimoku Cloud, right? And they can actually flip-flop, right? So when the green one's on top, the cloud is green. And when they flip over and the green one's on the bottom, the cloud looks red, okay? So does that make sense? So the Chiku Span A and the Chiku Span B, it's the midpoint of the Tanken and the Kijin, but it projects into the future, 26 bars, so it actually goes all the way out here, right? We are not here in time yet. This is 26, I'm on the 4-hour chart, so this is 26 4 hours into the future where the cloud stops, because it's projected forward like this, okay? What's up, ATX Music? How you doing? Welcome. Just going through the Ichimoku Cloud. If you got in late and you missed some of this, don't worry. This will be available online afterwards in VOD form, and you'll be able to check it out. So just to wrap up, we have the Tankenson and the Kijinson. That is the blue line and the red line. It is just basically a moving average. It's kind of a moving average of the last 9 bars and the last 26 bars. So fast average and slow average for the red one. Then we have the basically the cloud top and the cloud bottom, right? The cloud top is this little thin green line. The cloud bottom is the red line. It makes this kind of cloudy area. And when they flip over, the cloud changes color. Okay? Super simple. You guys get it. But seriously, WTF with the 9 and the 26 garbage? Hold the question just a little longer and I will get to that, okay? I will explain the significance of that. So one more piece, and then we've got it all. It's the Chiku Span, or the lagging span, which is basically just super simple. It's the current price bumped back 26 bars. Okay, let's show you what that looks like. So the current price backed up 26. So here's the current price. If we back this up about 26 bars worth, we will get something around here. And I'm going to light it up for you. Blink. There you go. So you notice that the shape of this up, down, over is the same as this, down, over. It's basically, here is a copy. It's a copy of the price chart back 26 bars. Okay? And that's it. That is all the lines. But these lines do so much. Clam Warrior, thanks so much for the follow. Very nice to have you. Welcome. Hope your night is going well. Feel free to say hi in chat. Okay. So. Now you're probably going to freak out if I don't explain what the 9 and 26 means. All right, fine. So, here we go. So to explain where the 9 and the 26 numbers came from, and you see those in the default settings of the Ichimoku Cloud, if you add this indicator and you just throw it on here, it's going to have these default settings, 9, 26, 52, 26. And I told you that that means, right, that's the numbers that are used for how far, with the median of how many price bars and how far you project each of these forward and things like that. So what's the point of all of this? So part of it is based on number theory. And it's a little kind of voodoo. It's a little Asian, Japanese voodoo stuff going on here, okay? Because, like, you know how Fibonacci retracements are, the Fibonacci sequence has, like, a certain harmonic value to it, and price is kind of likely to bounce at those values and retrace to those values, and it actually works? Well, there's some number theory behind some of this that actually works. The 9 plus 17 is 26, 33 plus 9 is 42. So there's these 10 numbers that were used as the foundation of this. And it's kind of like fibs, but the important thing is that this was developed in the 1930s for stocks and currency trading, right? Because we didn't have cryptocurrencies in the 1930s. So who effing cares, right? I just wanted to have that there for completeness. But really, it honestly does not matter. So, because this was done for stock and Forex trading, which has 8 hours in a day, right? If you want to trade stocks, you have outside of after hours trading, if you guys have ever traded stocks, you can trade it 8 hours a day in the New York Stock Exchange, right? 5 days a week. You can't trade on the weekends, right? And so there's around 26 trading days in a month when you add it all up together with all the time, roughly. So basically, TLDR, these numbers and the Ichimoku Cloud default settings were developed for a stock trading and Forex trading market, which does not trade 24/7, does not trade 7 days a week, right? So that means we need to change this. Because crypto is 24/7, so instead of 9, 26, 52, 26, we have 10, 30, 60, 30, right? Based on 30 days in a month, 24/7 trading, okay? So these numbers are adjusted here to cryptocurrency settings, right? So take my word for it. But what if we double these numbers? What would that do for us? So if we take 10, 30, 60, 30, and we turn it into 20, 60, 1, 20, 30, and if any of you guys have heard of Ichimoku Cloud settings, you've probably heard singled or doubled, and everybody has their own preference here, right? But basically, it's important to change the default settings of your Ichimoku Cloud. So like when I say, when you just install it and you put it in, it looks like this. You need to change that. So I'm going to actually take this off and open up my other indicator here, which is here. And so you can see that there, 10, 30, 60, 30, which is 10, 30, 60, 30. So this is cryptocurrency settings here. And I changed the colors just to make it easy for me to read. Don't worry about the colors. Don't memorize these colors because this is not what I use generally. I changed the colors up. You can set these however you want, by the way. You can be like, hey, I want the top line to be purple or pink or orange or whatever works for you. I like the Kijun line being red in general because it's the most important, it's the biggest. And I use it orange here in the singled settings, but in the doubled settings I use red. And I'll explain what the difference is between those. So what if we double them? You get 20, 60, 1, 20, 30. And basically what that means, so I told you what this means. This means we have adjusted the settings for a 24/7 trading market with a lot of action. What doubling them does, actually I'm going to explain what doubling them does after I show you the chart. So let's look at the chart a little bit with these settings. Let me find like a clean chart that I have not butchered too badly with all this stuff. How about, so this is actually just some live stuff. All right, so this is just Bitcoin. So like take a look at all of the indicators here, right? So the orange line is the Kijun, it was the 26 bar, but now it's the 30, right? And we have 10 bars back is going to be the pink, which is the Tankenson here. We still have the cloud, which is the red and the green, and it flips over when it goes the other way. And Epic Red Pill, I will get to your question in a minute after I finish explaining the Ichimoku Cloud, so hold that if you don't mind, and then I'll talk about specific coins and things like that, and other indicators. But basically, you can see what happens here relative to the cloud and the price, like just watching it, you know, as the price goes up, right, the price stays above these two lines, above the Tankenson, above the Kijun, right, and it eventually crosses back through it, and it crosses through the cloud. And what's really interesting about the cloud in particular is that most of the time when it hits the cloud and enters the cloud, it comes out the other side, right? Let's just look at this. I haven't actually prepared this. Let's just look how often that happens, right? So it did it here, and it went through. It did it here, and it went through. It did it here, and it went through. It did it here, and it didn't go through, but it came out here. It did it here, and it went through. It did it here, and it went through. Did it here and it went through, right? Did it here and it went through. Did it here and it went through. Like it's almost always goes through cloud. It's never 100%, but it's a high probability price movement that when it breaches the cloud, and when I mean by breach the cloud is I mean when the candle closes inside the cloud of whatever time frame you're looking at, it goes through. They call that edge to edge. It goes edge to edge, right? And the bigger the cloud, the farther the price is going to go, right? Like when it goes edge to edge, this is a lot of movement, right? When it's all thin like this, it doesn't go very far. But when it's really fat and it goes edge to edge, right? It has a long way to go through, right? So does that make sense? So the other thing you'll notice is like all of these lines, this line, this line, this line, and this line here are basically just a bunch of supports and resistances, right? You can think of them that way. You know how we draw our horizontal boxes and we're like, hey, yeah, you know, we have a support here, we have a resistance here, it's gonna bounce off it, right? So these lines, you can think of all of these lines as varying levels of support and resistance. Like if the price is gonna drop down, first it has to get through this, then it has to get through this, then it has to get through this, then it has to get through this. It has to go through 4 levels of resistance before it totally cracks all the way through, right? And you notice that it bounces a lot off these lines. Like here, price is trying to go back up, and first it bounced off the Tankenson here, and then it bounced off the Kijun, it bounced off the Kijun, it bounced off it, and finally it broke through, right? And then it bounced off it from the other side, and right. So these work a lot like horizontal supports and resistances, but they're not totally horizontal, right? They're crazy lines. So it's, you know, you can kind of think of them. You can think of them that way. So let's talk about some. I'll explain the singled and doubled settings as I kind of talk about how this works, so that I give you the proper context. But what does a bullish indicator look like on Ichimoku Cloud? Well, here there's a set of them. One of them is the price is above the cloud, right? Just simply put, you know, here's the cloud, the price is above it. This is kind of bullish, right? As soon as you get out of here, you get out of the cloud. It's like your plane's taken off and you're in the clouds, you can't really see, and you finally rise above the clouds and you're like, it's so nice up here. It's beautiful. As far as the eye can see, it's paradise, right? Like that's kind of what it's like when the price comes out of the clouds. It's like that scene in the Matrix where everything's dark and they go up through the cloud and you're like, blue sky, what is this? It's kind of like that, right? So that's a bullish indicator. But that's not the only indicator, and you don't want to just be like, I should buy when it goes above. Like there's a confluence of indicators that are important. Okay, a green cloud. So when the cloud is green around where you are, that's a bullish indicator, right? That means this line is above this line. When the green line's on the bottom, that is generally a bearish indicator, and it means the cloud is red where you are, right? Similarly, if there's an upcoming twist, so when the cloud lines cross, let me hide the price here. When the cloud itself twists, you see it? See how it looks like looks like I have like a piece of paper and I twisted it. This is called a Kumo twist. This is called the Kumo Cloud. That's what it's called. And when the lines cross, it twists. And it goes from green to red, and then it twists, and it goes from red to green, and then it twists, and it goes from green to red, right? So when there's an upcoming green, like, oh, because remember, it projects into the future. So if the price were only here, that was a better example. If the price is like here, and I'm like, are we going to recover from this point? And I look into the future, 20, 30 bars, and I see the red coming, I'm like, I don't know if it's going to turn around, man. I'm not so sure. That is a bearish indicator that the red is coming or that you're in the red. Like here, hey, we're flying high. This is great, but we're in the red. So that is one bearish indicator. We'll get to that. So price above cloud is a bullish indicator. The green cloud or upcoming green twist is a bullish indicator. A Kumo breakout or an edge-to-edge up. So what that means is when you break out the cloud, just means you come out on top, right? Because breaking out on the bottom is bad, right? So when you break out the top, it is generally a bullish indicator. It doesn't always play out, right? Like here you broke out the cloud and you went right back in. So like I said, these are not 100% universal indicators that you should buy, but when you take them all together and you add all of these up, if there are all 5 of them, there is a really, really strong signal, okay? Lagging span above the cloud. So lagging span, remember, is the this line here that follows the price. So let me just get all the way back here. So here's the price, and here's the copy of that price kind of projected back a bunch. If that is above the cloud, that is a bullish indicator as well, right? So here we have the price above the cloud, the price above both lines, the lagging span. So right now, like today in Bitcoin, we are pretty bullish in general. We have all of these things going for us so far, right? Let's see what else we've got. A bullish Tk Cross. So what does that mean? Well, if you remember Tk, the first 2 lines I showed you, the Tanken and the Kijin, in this case, it is the pink and the orange. When these 2 lines cross, and they do it a lot, like here's a cross, here's a cross, here's a cross, here's a cross, right? Let's take a look, here's a cross, right? So when these lines cross, it means something. It means that there is potentially a reversal or a continuation coming, right? So a bullish Tk Cross means the Tanken, or the blue line, or the pink line in this case, blue, pink, crosses above the Kijin, which is the fast line crosses above the slow line, right? So when that happens, for example, let's find a good case of it. Let's just go back and find a good Tk Cross. Here. So here you'll see that the fast moving line, the pink one in this case, crosses above the orange line, crosses up over it. And as a result, this is a bullish indicator, right? And the price is going to go, it happened to go up with it. We were below the cloud, which is bearish. We had a green coming up, but some red coming up, so that was kind of bearish. But it did break through, right? We had a breakout. We had an edge to edge. We have the lagging span up here. So as soon as we broke out here and the lagging span jumped out of the cloud, we had breakout, positive Tk Cross happened back here. So it had a bunch of positive indicators and the price went up, right? And another bullish indicator is called a bullish Kijin bounce. So what is a Kijin bounce? So the Kijin in this case is the slow moving line, which is the orange one. And a Kijin bounce means, a bullish bounce means the price is up and it bounced off the Kijin, trying to come down. So here is a bullish Kijin bounce. We bounced off the orange line. Here we cracked it, so that was not a bounce. Here, so bounce off the orange line, right? Here we cracked it, so that's not a bounce. This is a bearish Kijin bounce, right? Because you bounced the wrong direction off it, right? So, but here's a bullish Kijin bounce. Does that make sense, right? Whenever you bounce off the Kijin and go up, that is considered a very bullish indicator, right? So that's basically all your bullish indicators. If you have all of them, it's super, super bullish. And then there's bearish indicators. So it's kind of going to be the opposite of these, right? This is going to be pretty obvious. Price below the cloud, right? Obviously, all of the opposites of these are going to be bearish, so I'll just go through them. A red cloud or incoming red twist. So if the cloud is red where you are, it's bearish. If you're here and you see the red coming, it's bearish, right? So the price can go down. You've got a Kumo breakout or an edge-to-edge going down. So when you break out below the cloud or you get an edge-to-edge that goes, you know, here to here, it could be bearish. A lagging span below the cloud, so that's the copy of the price behind you. When it is below the cloud, it is bearish. And a bearish Kijun bounce, which is the opposite of this. So one more thing I need to mention here, and I didn't write it down, is the location of the TK cross is one of the most important indicators of both of these. That is when these lines cross. And when you have a cross, it's either a bullish cross or a bearish cross. Bullish cross is when the fast-moving line, the Tanken, crosses up over the Kijun, right? Because when the price is going up, the Tanken's going to be on top, the Kijun's going to be on the bottom. So whenever it crosses to achieve that, it's bullish, right? So in that case, a positive cross looks like this. This is a positive cross right here. Ignore the yellow. Right here, we crossed up. That's a bullish TK cross. But whether this happens below or above the cloud adds or removes strength from this signal. If a bullish TK cross happens in what we call bullish territory, which is above the cloud, right, where it's all paradise, if you get one of these up here, it's like 2x strength. It's a super TK cross, right? It's super bullish. Here we have a bullish TK cross in bearish territory because it's under the cloud. So it's kind of like, it's good, but it's not great. Similarly, if you get a bearish TK cross, the territory can either double it in strength or half it in strength, right? So let's give an example. So here, this is an example of this is a bullish TK cross, and here. So right here, we have a bearish TK cross, right? Right here, the Kijun went above the Tanken. That's bad. You don't want the Kijun to be on top. You want the faster moving one on top, right? But since we had a bearish cross and it's below the cloud, that's bearish territory. So right here at this moment, that is a double bearish sign. And sure enough, the price goes down and went down before it came back, right? So this is a very kind of a super bearish sign. Whereas this right here is a positive TK cross, but it's in bearish territory, and the price was like right here when that happened. So you're like, and sure enough, it didn't actually do anything, right? It kind of went down. So the location of the TK cross is really important. So let me now show you the difference between the singled settings and the doubled settings. Okay, 10, 6, 30, 60, 30, which is basically like tailored for cryptocurrencies, 24-hour, 7-day-a-week trading. And then there's the doubled settings. So here is the singled settings, and it's not going to look very different. Let me actually find a difference to show you guys. Okay, so here you can see, right here, we have a breakout of the cloud, right? The price, right here where I made this yellow circle, right here, the price jumped out of the cloud right there, and we have a TK cross. The pink line, which is the Tanken, crossed above the Kijun right in here. So you've got the positive TK, the bullish TK cross in bullish territory. You got a cloud breakout. It's a good move, right? The price above the cloud. The lagging span is in the cloud, so it's not great, but not very long after that it was out. But you don't have to have all the indicators, right? But right here you can see, if you were watching this on the 4-hour, you might be like, ooh, that's pretty good. When this candle closes, that was pretty great sign, right? So I'm gonna turn on the doubled setting so you guys can see. Okay, so here's the doubled settings. Okay, so in the doubled settings, I made the Tanken line blue and the Kijun red. These are the settings I use almost all the time. So it matches the colors that I had on the chart originally. The Kijun is red, the Tanken is blue, the faster moving line is blue, the slower moving line is red. The red one's more important, but the blue one you just watch, right? So just like we have before, when the price is going up, the blue one's on top, the red one's on the bottom. That's what you want, the red one to be on the bottom. When the price is going down, the red one's on top, the blue one's on the bottom, okay? So here, looking at the same, the doubled settings, it kind of shifts everything, it shifts everything a little bit. So, whereas on the singled settings, there was that breakout right here where I drew the arrow, that same breakout did not occur until much later, not much later, but a little bit later, like a day or two later, the same breakout on the doubled settings. Here we broke out of the cloud, right? The TK cross was back here, but the breakout was not till here. So you generally wait for it to break out of the cloud. So what the main difference in the singled and the doubled settings do is the doubled settings are slower. You find out about things that happen a little later. So why would you ever want to use that when it's all about making fast moves, right? Well, the downside, so the downside is you find out about it later, but the upside is it's more accurate, right? Because when you're looking at the 4-hour settings here, for example, on doubled Ichimoku settings, you're actually viewing the 8-hour cloud, right? So this is the 8-hour cloud on the 4-hour settings. If I go down to the 1-hour chart, this is the 2-hour cloud on the 1-hour price, okay? And the reason you would want to do that is so when you get a signal, so you'll end up making less trades if you use the doubled settings, but they will be more accurate trades, right? They'll be safer trades. They'll be better trades. It's less prone to fake outs, when the price, dips in the cloud and comes back out or breaks up above the cloud and comes back down. You're going to have less, that's going to happen less often if you use the doubled settings, but you will take less trades, okay? So does that make sense? So doubled settings, we found out about this kind of breakout later, and singled settings, we found out about that breakout earlier, right? So TLDR, doubled settings give you information slower, but more accurately. Singled settings give you information faster and, more prone to fake outs. They're both super useful. I like to have both of them, but they each have their own, their own pros and cons. So let's go to double because I pretty much use this most of the time. And we'll let's actually just look at some charts with this and see what happens. So let's take a look at let's try Neo perhaps. Let's look at the Neo chart. Yes, this is live. JR Vermilia, how you doing? So just looking at the chart here with the cloud now, right? And I will mention that you usually want to be on the higher time frames for this. You can use the lower time frames, but keep in mind that if you jump on the 5-minute chart and you see a breakout or a bounce or something, it's usually only good for so many bars. And if the bars are 5 minutes, the move might be good for half an hour. So you go get a sandwich and it's already played out, right? So you can do this, but it's, the higher time frames are always stronger. And any signal you see on a higher time frame always trumps that of which you see on a lower time frame. It's just really important to use the higher time frames if you can. The moves are slower, they're nicer, they're more accurate, and but you can use this strategy on the lower time frame if you're just sitting there glued to your monitor. Just understand that if you see a different signal on a higher time frame, you need to go with that. Okay. So we have a breakout here. Here is this a, I think I circled this on the singled settings. Why did I circle these? Okay, so on the singled settings, we have a TK cross here and a TK cross here and a TK cross here. These are crosses, right? So when the crosses happen, you ask yourself, is something going on? Do I need to be aware? Is the movement changing? So you're watching for those here with singled settings. And if I had these on doubled settings, the Kijun's way the hell down here, and there's nothing that happens until here, right? So you would have been in this trade all the way until here, whereas if you were looking at the singled settings and you were in this trade, you might have considered getting out early, right? Which you would have lost a little bit of profit there, potentially, right? So just to show you guys how the difference works. Let's see where we're at today. So today looks like we started an edge to edge. We had a negative TK cross up here because the Kijin went on top. You don't want that. You want the blue one to be on top. So we had a negative TK cross, but it was in bullish territory above the cloud, so that that reduces its strength by half. We crushed through both of these here. So the crushing through, we broke through the Kijin. We had a negative cross. We broke into the cloud. Looks like it went edge to edge. Looks like the wicks went all the way out. It did, right? So it did complete an edge to edge, but then it actually bounced back up, and it looks like we went edge to edge again, which is pretty awesome. But we haven't closed outside the cloud yet on the 4-hour chart, and we've got about an hour and a half left on Neo today, live. Will we get outside the cloud? I don't know. We've got kind of the wrong direction here for the Kijin and the Tanken, but it's still possible because it was above the cloud, but it went back in. Generally, when price is inside the cloud, consider it like you're a pilot. When you're flying in a cloud, you don't want to make any big moves, right? You could hit a mountain. So that's the analogy for when the price is in the cloud. It's generally considered a no trade zone, with the exception of taking the edge to edge and going, ooh, we went edge to edge. I got enough indicators to believe we're going to hit the other side. I'm going to short this and close here, or close when I come back or something. Like, that's the only time you want to take a trade when you are in the cloud. When the price is just bouncing around in the cloud, you generally want to consider it a no trade zone. Just like you were flying a plane and into a cloud, you're not going to mess around and do tricks. Don't screw around when the price is in the cloud, because you will get wrecked more often than you will succeed, with the exception of the edge to edge trade. Okay? So let's go to another chart. Let's go to something like Nano. What did I mark here? I think this is probably a difference between singled and doubled settings again, just so you guys can see. Okay, so here you guys can see a bullish TK cross, right? In bullish territory, which is a really, really strong sign, right? It's a double strength when that happens. So when that happens, you would buy here, and right, and it goes all the way up here. And generally, you're looking to close when you crack the Kijin in the wrong direction, right? So you would have bought here, and you would have sold here, and you're probably about break even or pretty close, right? But you would have saved all of this, right? Which is pretty good. And then if you were on the doubled settings here, you probably would have got in here, and you would have sold here when it hit the Kijin. It bounced off the Kijin though, so it's hard to say. Usually you use the Kijin as your exit point, right? When you are buying long and price is good, let's go back a little bit and show you some examples of when you would get out of a trade. So oh, we don't have enough cloud here for Nano. Nano on Binance. The problem with using large time frames on like Binance is if coins haven't been around that long, the cloud doesn't have enough time to form. So let me pick something let's just use Litecoin or something, or Ethereum, or just Bitcoin is fine. So, for example, if you were short here, you're like, hey, we broke out of the cloud and I'm going to short Bitcoin. You would go short here. Everything's great. Everything's fine. You're making all this money. You're making all this money. And here we crack the key. Here, bounced off the Kijin. You have your finger on the sell button here. You probably have your stop loss just on the other side of it. So it would bounce there and not trigger your stop loss. And then you'd get stopped out here. But, that's a pretty nice, that's 10% you just made right there, which is pretty good, right? So, and then on the other side, so if you were buying this now, if you were buying Bitcoin now, you had a good cross there. You might have taken your, if you were on the singled settings, you would have taken your breakout here. Otherwise, you would take it here. So you'd be long from here. And right now, if you had bought here, you would be up about 14%, and up at the top here you would have been, actually you would have sold right here because it cracked the Kijin. So you would have made 7%, not too shabby, not too shabby. And then you might have bought back in when it bounced back up. You might have bought back in here, just saying like, hey, that's a bullish signal. We passed the Kijin on the other side. I'm going to take this trade, and you'd be up another 5%. It's pretty cool, right? So there's this is a very versatile set the indicator. It's kind of like 7 or 8 indicators all rolled into one. And this is why it's just super powerful, right? Let's look at a couple of other charts. Somebody give me a coin. Just type a coin if you want in chat, so you can see that I haven't rehearsed any of this, right? We're just gonna look at something. I mean, I can pick them all day. I'll just pick a random one. I don't know. I'm just, where the wheel stops, nobody knows. Bing. Okay, ENG. Let's look at ENG. Let's just go back in time to something I wouldn't have been looking at, right? Just to show you how powerful this is, right? This history doesn't go back that far. So here we have an edge to edge, right? We have a bearish, we went in edge to edge here. You might be like, I'm not sure if it's going to go. And then you have the bearish cross here, and you might say, all right, I'm going to take this edge to edge right here, right? And you would have sold right there. And then it went back up. Would you take the edge to edge? I don't know. Maybe if you did, you would have made all this back. ADA. Okay, Kron, I got you. I'll check ADA in a second. Right? So if you went edge to edge here, so like look how much money you would have made just trading edge to edge. Right? Then there's so many more ways to trade this indicator. Edge to edge is only one of them. And it doesn't always play out, but man, it sure is likely when it happens, right? So first you would have made this. First you would have made 30%. Dear God. Right? Until it maybe cracked it the other direction. So okay, 20% there, right? And then you're like, well, it cracked it, so now I'm going to go long. And okay, you take the edge to edge, and then it broke back down, and you're somewhere in the 30% there, okay? And then you're like, oh, we're back in. Let's take another edge to edge. Bam, right? And another one, bam, and another one, bam. And then, okay, you took an edge to edge here, and you got stopped out, okay? But look how many positive trades you got. You've probably doubled your money by the time you hit this one. You didn't make it, right? Like, it's just incredible, okay? And then, okay, so maybe you go short here because you're bounced back out, and you can't short this directly. I mean, on some exchange you can, but let's say you could, right? So you'd be short here. Right, and what you're waiting for now is you're waiting for it to crack the Kijin. So you're short here. So let's start a short position here. Okay, right when we cross through and we break back out. Okay, so I've started a short position. Right, here we go, and I go all the way down here, and I'm not sure. It depends like we didn't close above the Kijin. We actually bounced right off it. Shows you how like a perfect Kijin bounce. Right, it's a bearish bounce, but for you that's good because you're short. So you go down and you get all of this, and here we cracked the Kijin, but we didn't close. But when you saw this candle go all the way up, you probably freaked out and probably triggered your stop loss. So you got to about here, which is you made 15% off that. Not bad. Unfortunately, you didn't get all of this because this flash here, but if that didn't happen, or you had the balls to stay in because the candle didn't close over the Kijin, you would have been into all the way to here. You would have been to here, but then then you probably would have sold up here, and you would have only made less. You still would have made money though. 10%. Damn, only 10. Feels bad, man. Right? Edge to edge, edge to edge, edge to edge, edge to edge. Look at how much money you would have made if you just did edge to edge, right? On Enigma. Edge to edge, edge to edge. Look at that. It's only missed once in all of the history that we've been looking at on the 4-hour chart, right? Okay. All right. Does that count? I mean, edge to edge, right? You would have sold it there. Edge to edge, sell it there. Okay, it missed. Here's a miss. Here's a second miss in all of the history we've been looking at, right? And here is another miss recently. Here's another miss. We did not go edge to edge. We went down and up. But when that happened, you probably broke almost even. Like, how much would you have lost if you bought right here and you sold right there? 1%. Okay, so you're down 1%. But, I mean, you practically already doubled your money. So this one didn't play out. Where's another? Here's another one that did kind of half play out, but then it didn't. So, okay, so you miss something, but you can see how many times those edge-to-edge trades play out. And don't just use edge-to-edge. Like, I'll tell you what increases the strength of the likelihood of an edge-to-edge to play out. It is a TK cross just before it in the direction you want to cross, right? So in that case, let's go back a ways. So we're down here, right? The Kijin is above. Here we have a cross and then a recross. And then, okay, here. So here is a positive TK cross in bearish territory, which is not great, but as an indicator of whether or not we're going to go edge to edge, it's pretty good, right? Positive TK cross, that means things are looking good. We have the green cloud coming up, another bullish indicator. We broke through the cloud. Is it going to go edge to edge? I would say 1, 2, 3, yes, right? Like, I would say this is a pretty good likelihood that it is. And so you buy and you get that edge to edge. And then how about here? So here we have a negative TK cross, right? The Kijin went above, which you don't want, right? That means the price it's a bearish signal. But it happened in bullish territory. So, okay, it's not a super bearish signal. It's a half bearish signal. But as far as, hey, are we going to go edge to edge here? It's generally a good indicator. So we have an edge to edge. So you might have taken this, but it would not have played out. Okay, so it wouldn't have played out that time. Is there any other indicators here? I mean, the lagging span was above the cloud too, so that's a bullish indicator. And if you're wondering, is it going to go bearish all the way through the cloud? You've got a couple of things working against you there, right? You do have the bearish cross. You probably didn't have this red in the picture. It only goes about 30 bars forward. So it was looking green when we entered the cloud. So you might say, I'm not really sure. Like, if there was a twist to red, it's a lot more likely that it's going to go all the way down through. So I'm just trying to show you guys, like, how would I know I'm going to get a fake out? Some things you might look for to help that, right? So, for example, here, like, here's another example, right? There is only green. There's no red. It doesn't even look like it's going to twist to red. And when it broke into the cloud here, do I think it's going to break all the way through? There was a bearish cross, but I only see green ahead. The lagging span's up above the cloud. I'm not so sure it's going to cross through, right? Like, I don't know. Like, right now, would I take this trade if it crossed through? Probably not. Probably not. So let me tell you some other thoughts. And I've already talked about some of these, but I'm going to wrap this all up for you guys in a nice package. And then you guys can ask some questions. The cloud is usually a no-trade zone, just like you're flying a plane. In general, when the price is in here, just stay back and watch. Unless you're taking an edge-to-edge trade, and it requires a confluence, which means it needs validation. If you're going to try the edge-to-edge, usually you want to see a good TK cross, which means, hey, if I'm gonna edge-to-edge this, I want to make sure that I get the bullish cross, which I did before I do it, if possible, right? Or other indicators. Like, you could pull up the RSI and say, hey, is the RSI low? Yeah, that's a good. So when you're looking for edge to edge, you want to look at other indicators. You want to look for the bullish, the signals in whatever direction you're hoping the price will go, and look for confluence, which means a lot of things agree with each other before you take the trade, before you take an edge to edge. Even though the edge to edge is high probability, even without anything, you saw how many times it was just right on through the cloud, through the cloud, through the cloud, through the cloud. You still want to go for the confluence because it makes your decision even stronger. Okay, so hopefully that makes sense. TK gaps always close. So what does that mean? So what that means is when the two lines, the T and the K, the Tanken and the Kijin, get far from each other, which is also known as a C clamp, like makes a big letter C, with the lines. Let me find one of these for you. Where is a good C clamp that we can look at? So see here, see how far these are away from each other here? The further these two lines get away from each other, the more they are going to be like magnets and come back together. So the farther they get away, the more you should be thinking, is now a good time to take profits? Let's look at Bitcoin. Let's look at what happened to Bitcoin at the beginning of the year when everybody got wrecked. So here's Bitcoin on the floor. Jesus, I have so much stuff on this chart. Okay. So look how far these indicators got from each other. Like normally these lines are pretty close. They're pretty close. They don't really go that far. Here, look how far they went here. And look what happened. Bam, price goes down, the lines come closer together, right? This is in the euphoria period of last year, if you guys remember this, in December, okay? And look how far these got from each other. This should have been a huge sign that the price might correct, that everybody was just like, woohoo, we're sailing high, we're never coming down, 50K, or I eat my junk on national TV, right? Like, but this is a huge warning sign of things to come, right? And look what happened. Bam, 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 right? And now the lines are closer together. So TK gaps always close. Always. They never don't close. So the farther they get away, the more you should have your little red warning light on that says, be careful, okay? Large time frames is always more useful and stronger signals than the smaller time frames. When I first learned this indicator, I took it to the 5-minute charts and I was sitting there on Coinbase going, oh, we got a Kumo breakout and a TK cross. I'm going to buy. And dude, I got wrecked a lot because I'm just sitting there looking at the small time frames, just getting antsy, trying to trade. Just use the large time frames. Stick to 1 hour minimum. Don't go below that, right? In general. It's fine if you want to look here at the 30-minute, but don't make big decisions off anything that's like less than 1 hour or 4 hours, or even 1 day. The large time frames are super useful. They're super strong, and you don't have to like rush to your keyboard to make a move. You have plenty of time to act on these because when a move happens, it goes like so many bars, and if you're looking at the 1 day or the 4-day chart, you have plenty of time to see how that trade plays out. So it's nice and relaxing. Go watch TV, go on vacation, check the chart, once over the weekend. You'll be fine using the large time frames. I can't stress that enough. It's just, it helps your stress levels so much, right? And in general, this indicator is a little bit vulnerable to fake outs and no repeats. We showed you a fake. A fake out is when it looks like it's going to do one thing and it does another thing. Because the Ichimoku Cloud is based on historical data and moving averages, you're always going to be vulnerable to like the coin is doing a correction right now, like a really strong correction, and it messes with the averages and it creates a fake out, and then it, like you say you're in an upward trend. Let me see if I can find an example of this. So for example, let's look at Bitcoin when we were in that big downward trend, right? So we're in this big downward trend, right? And we have this nice breakup through the cloud, but we stayed in this downward trend till all the way over here, right? So this huge 4-hour downward trend stayed with us from like the end of December all the way to April, right? But there were some positive Ichimoku Cloud signals to be had in here, and maybe you make a little money on it, but you got to be careful because you're still in the downtrend. Like this correction up in this case, or the correction down, fast corrections can mess with the averages, so you want to be careful a little bit. And that's why the doubled settings are good, because they're less vulnerable to fake outs and screwing with the averages, because you're looking at a larger, kind of longer cloud. That's why the doubled settings are better and safer in my opinion. But that doesn't mean that the singled settings are bad. It just means that, if you're worried about getting faked out and getting a reversal on your signal, it happens less often in the doubled settings, the 20, 60, 120, 30. And you don't actually double the 30. So the 30 is just how many bars you project out, and there are 30 days in a month, and that's how many days you trade. So don't change the last number when you double. When we say doubled settings, we are talking only about these settings here. We do not double the 30, okay? That's really important, because a lot of people go 20, 60, 120, 60. No, you do not want to do that, because then your projections are all completely screwed up. So the last number is always 30. In stocks, it's 26. In crypto, it's 30, okay? But you're doubling all of the other settings. And when I say those settings, I'm talking about these inputs. 1, 2, 3, 4, 20, 60, 120, 30 when you go into your inputs. That's what we're talking about here, okay? Okay, so where does that leave us? We're just on the last but not least, vulnerable to fakeouts. And no repeats just means, since we're dealing with historical data and moving averages, sometimes things don't repeat, right? And when that happens, your previous data is not going to match up perfectly well, but there is a lot of repetition in crypto space. So just like stocks and in human patterns and psychology, when you see something, people tend to do the same things. So it's a really, really strong indicator. So please, if you guys have questions, ask. That's kind of the overall summary on Ichimoku Cloud. I hope you guys have learned some things. We can go to a few coins. Somebody said ADA. I already have that on my watch list. So let me find it and we can take a look at ADA. Let's look at it on Binance. Whoa, I have all kinds of... I've been trading. I have some of this. It's a really good fundamental project. So I've been trading this for a while. Let me see if I can find a chart though that doesn't have any markings on it. Let's grab the one on maybe Bittrex. Okay. So I mean, just looking at the chart here, it looks a lot like a lot of alts, which is wrecked since the beginning of the year, and now things are accumulating and actually starting to go back up, right? So let's see how the cloud can help us here. Could the cloud have predicted that we were going to go down? Let's see. Here is a bearish Tk Cross. Was in the cloud though. It wasn't quite in bearish territory. Here was a bullish cross in bearish territory, but we didn't enter the cloud. And then a recross. Okay, now here is your first real signal. We have a bearish cross in bearish territory. The price is below the cloud. The price is all red. The cloud is red coming up. So all of the negative indicators are coming together here. Red, price below cloud, negative Tk cross. Lagging span is below the cloud back here. Your 20, your 30 periods back. Everything is setting up for this to be very bad. So you might have shorted here, then you would have got stopped out, but then you might have taken it again here, and let's see what would have happened. We're going down, so you would have entered the trade, let's say somewhere around, I don't know, here. Let's just say you entered the trade there. And after getting stopped out here, you lost a little bit here, not much. It was like a couple percent maybe. Okay, so you're going all the way down here. Things are looking great. You're not even coming close to the Kijun. They're starting to get far apart, though, so you're worried. We got a bounce here, so you're still fine. Coming down, coming down, coming down, coming down. We hit the Tanken. That's fine. You don't care about that. A little recross here. You don't care about that. Another Kijun bounce. Another Kijun bounce. Perfect. That's exactly what you want to see. That means continuation. And we crack it here. So let's see how much you would have made had you made that trade. God, I can't even go back that far to get my indicator. Where do we open our short? Okay, so we open the short here. And where did we end up? Where did we crack the Kijun? Not till here. So cracked it right there. And I got to bring the bottom up because we would sell it right there. 50%. Not too shabby. Not too shabby, okay? So now we're here in time. And let's see what we see today. So we have a bullish cross. We already entered the cloud, though, so not really a super strong indicator for an edge-to-edge because we were already in the cloud when this happened. So you're like, nah, I'm not really sure about that. Price below the cloud. I don't see any green coming up because we'd be about here. So I'm not sure I'm going to take this edge-to-edge trade. So you pass on it, and it doesn't play out, which is great for you. And now we have a bearish cross in bearish territory. That's bad. And then the cloud is getting so thin, and you see the green coming, and you're like, oh, could this be sunny days? The other thing is, when the cloud is really thick like this, it's actually harder for it to get through, right? It has to go through this and like all this garbage before it gets to this and finally through. When the cloud gets really thin, it actually becomes kind of like a magnet for the price, and it's very easy for the price to just go beep. It's like just slips by. Like if the cloud's that thin, there's no turbulence on the flight, right? You just kind of go right through there. So that happened. And let's see if we have a Tk Cross. Is this in bullish territory? Yes, it is. So here's a bullish TK cross in bullish territory. This is actually a really, really good sign. Now, you might have taken a trade here, with the exception of, yeah, you got green ahead. So let's say you took that trade right here. Put that guy right here. You probably took it here. Dink. Okay. And we went up here. Okay, we have not passed the Kijin. We're bouncing off it, and it looks like you cracked it here. But you gained a few percent here, probably. And then we cracked, and then we went above it here. We're bouncing off the Kijin. So you might have taken this Kijin bounce as a, right? Because we're bullish. We've got the Tanken above the Kijin here. So it's a bullish indicator. You've got price above the cloud. You've got lagging span above the cloud. You've got green sunny days ahead. So you might have taken this bounce, this Kijin bounce, as a continuation of bullish movement. So you might have taken a trade right here. Beep. Dear Lord, why is it making this so big? And if you did, you would still be in the trade. We have not interacted with the Kijin, so you're looking for it to break the Kijin to stop the trade, and you would be out of the trade right here. So let's see what happened. You would have made... You'd be out of it right there when it broke the Kijin. And you would have made 18%. Not bad. That was just a couple of weeks ago. And now we have a bearish cross. So this right here is a bearish cross. But then there's a recross. So you probably would not have been in for any of this based purely off of the Ichimoku indicator, at least on doubled settings, right? Maybe if we go to singled settings, you would have seen this. So let's see, if I'm in singled settings, do I catch this? Not here, not here, but we get a breakout here. So you probably would have bought here. Yeah, so you would have taken this trade here because you had a bullish cross, and then you broke out of the cloud. So you probably would have taken a trade here on singled settings. But like I said, you might be thinking, well, dude, single settings are better. They're better in this case, but they're also more prone to fake outs, right? So you would have caught this on the singled setting, and you'd be flying high up here. You'd still be in the trade. If you were on doubled settings, you probably would have passed this one up, unless you decided to buy off this Kijin bounce here, and then you'd be in it somewhere over here, and you'd still be up. Like, you'd still be up. You're going to take fewer trades on the doubled settings, but they're going to be stronger trades. You'd be up 10%, right? Not bad. This is not bad. So, unfortunately, my time is up, guys. I want to keep these to an hour. Sorry I didn't get a chance to go through more TA on coins. I just wanted to really go over the Ichimoku indicator. You guys can feel free to ask me any questions. I'm available on Twitter. You can catch me at... I'll put my Twitter in the chat here. At Kevin Lambert on Twitter. I do not hide my identity like a lot of people in the space do. I'm always going to be real. I'm always going to be truthful. I'm not going to use a weird picture of myself. I'm not going to use a strange name. It's me. It's there. I'm there. I'm out there. I'm letting you guys know who I am. I'm always going to be truthful. And I'm going to share with you guys everything I've learned in hopes that you guys can use this in the way that I have had and have the kind of success that I've had using these indicators. So again, if you guys have any questions about Ichimoku, feel free to at me at Twitter or catch me in the Coin Chasers Discord or anywhere that you can find me. I will respond to every question, and hopefully you guys learned something tonight. If you have any questions next Saturday, we can hit them. We'll go over more coins. Next Saturday will probably mostly be just TA. We'll look at a bunch of different indicators, RSI, and a bunch of different things. And I'm going to switch over to playing Duelist. If you guys like to watch video games, you're welcome to stay, but this is the end of the Saturday Night Crypto. If you do have crypto questions while I'm playing Duelist or a game, you're welcome to ask and hang out, but I'm going to switch the stream over to Duelist, where I play some video games, because that's what I do pretty much every day. So thank you guys so much for hanging out. I hope you learned something, and I will see you crypto folks next week. And until then, I'll catch you guys on Twitter and in Discord. So have a good night, guys. I will see you next Saturday.